Emily, I got your email and I will get back to you. I've been out of the office all morning, so
You're fine. You're good. Take your time.
I don't know if you guys knew, but I started a property management company about a year ago, and I've been knee deep in that. And we just on Friday we signed a 77 unit portfolio. So 40 of those units are downtown in two buildings. So we were touring that. So I've just been out of the office all morning, but
That's not a small feat.
no, it was good. Yeah,
That's amazing.
we were managing 60 units and then now we're going to be managing
Double.
140. Yeah. So 135. So it'll be fun.
Good for you.
Um,
Congrats.
thanks. All right. Sounds good. Well, I hopefully if you're on here, you're here for I guess it's August already, which is insane. Market update. Let me get my slides rolling here. I need to share my screen first. Does anybody else have anything to add about the market or something that you guys wanted to talk about before we jump in? Or just here to,
Do you do property management in Florida?
I do not. I think I need management or real estate in another location about as much as I need a new wife, which is what I would have to do if I started managing in another state. So
Gotcha.
yeah, we just a real quick side and then I promise I'll jump into it. So if you're familiar with hockey, I'm not sure it happens in any other sport, but in hockey I have something called billets. I know it happens at older kids' age, but my oldest, who's 14, has a teammate. Well, he has two teammates that are billeting this year. One's living with their grandparents. He's from Alaska. But then we have a third boy that moved in yesterday, and I was in Columbus, who will be living with us from now until March. And so I was gone when Ashley had to move him into the house by herself. So she didn't say she was mad at me. She's nice and she probably never will, but I don't think that she was excited about the fact that I'm gone this week when we have a new son as of yesterday. So anyways, all right, cool. Well, let's go ahead and get started here. So I think most of you guys on here already know who I am, so I'm going to save that. But I've been in real estate since '04, investor, and I just love numbers. Um, I've got kind of the normal info, but I think there are some good stats, some good things, conversation pieces for sure to talk about as we go through the numbers. I think some good trends, and then obviously also just probably some things coming out in the stats that we've already all been feeling for a little bit. So I think there are some interesting numbers. So the first, we'll start with the good news. If you haven't been paying attention, we're at basically the lowest rates that we've been at since last October. It's not a huge improvement compared to where we were kind of middle of spring, but definitely nice to be there. And the thing that is most encouraging is that we've kind of held on to these lower rates for what's it been like a week and a half or 2 weeks now. We had what most people probably would consider a bad inflation number at the end of last week, and they still held pretty firm, around that 6.5 average. I think some local lenders are a little bit lower than that. Um, but for the most part, we've been around there. Sorry, they're breaking up ice. Hopefully that'll be over in a second. Um, but yeah, so that's a good trend. If you have had anybody that's paused looking over the last 6 to 9 months because rates were too high, I'd highly recommend a call back with a picture of this graph from Mortgage News Daily, or at least a text that says like, hey, I just wanted to give you a heads up that we're at record high available homes for sale and we're at the lowest interest rate since last October. So if you're still even considering buying, we should jump on a call. In terms of interest rate movers this week, I don't think there's like NAR stuff comes out, but as you guys know, that's like a month and a half old. So by the time they actually come out with that to Wall Street, we're way ahead of the game on that. But the biggest mover this week for interest rates is there's a symposium every year in Jackson Hole where a bunch of Fed, basically people similar to Jerome Powell get together from all over the world and they talk about what's happening in rates, and then a bunch of economists too. And so at the end of the week, Jerome Powell will give a speech. Typically, he kind of outlines like where they see the rates and all of that stuff moving over the next 6 to 12 months. So it's kind of pretty similar in like the importance to like a normal Fed meeting, which we had one at the beginning, or no, it was like July 20th. So it was like 3 or 4 weeks ago. And then we'll have another one in September here in like a month. And so as this says here, the market says that there's 85% chance that the Fed will reduce rates next month, which doesn't always automatically impact mortgage rates, but it's usually puts downward pressure on mortgage rates. So I left this. This is from ChatGPT, by the way. I was like, please describe Jackson Hole. The unexpected twist at the bottom that there's been several bat encounters at Jackson Lake Lodge where the symposium is hosted was just hilarious to me. I almost deleted it and I was like, no, like we're talking about stats. It's boring as hell. Like, let's leave the bat thing in there. But what Chat GPT comes up with sometimes is just hilarious. All right, I've been putting these in here the last couple of months, and I think it's pretty interesting. And the reason I think that it's interesting is that what I've noticed is that consumer confidence, which is extremely emotional, just drives so much behavior. And specifically with real estate, I think that our industry and like how many buyers are truly out there and pulling the trigger trends really, really closely to these numbers, and not necessarily the numbers themselves, but more so like the direction of the trend. So I think this is like kind of the most telling one down here on the bottom left. But you can see that in April, after the tariffs were announced, that was kind of, well, May actually technically had the lowest consumer confidence rating over the last 12 months. But as you guys know, that happened right during what is our busiest season in real estate. And so I think in general, you know, it happened during COVID, and then it happened this year with the tariffs and the stock market tanking during that time. It definitely makes for a weird year when the springtime is just not necessarily as crazy as it typically is. And so what I think is going to be really interesting is that since April and May, you can see that consumer confidence has gone back up. Now, the interesting thing is it was spiking really high in July, but it's still above 60 in August, and that's a prediction. They haven't really 100% finished yet. But I just think that it's really interesting to see that, you know, what we were all feeling in the market during springtime was that it was definitely slowing down. Obviously, the inventory numbers and everything else show that. It'll be interesting to see with dropping rates here in the fall, along with higher consumer confidence, if we actually end up having maybe a little bit stronger fall than we're expecting, or that has been typical over the last few years. So it's something I'm definitely keeping an eye on. But you can also see from the upper right, this is the consumer's expected change in prices. Now, I always think it's funny because, I mean, if you walked up to the average person and asked them, like, what's inflation going to be next year? Like, first of all, if they give you an answer, I would ask them, what does that mean to you? And I don't think most of them would even be able to tell you. It's a completely emotional response to probably the news more than anything. But it's just interesting to look back. Like, you can see that in April and May, they were saying that they felt like inflation was going to be at 6.5%. And then now they're saying like last month was 4.5%, and this month it's 4.9. But you can see how the emotions of just like what's going on is impacting consumer behavior and what they think is going to happen with pricing. The one thing I would tell you about this is, like, honestly, if somebody believes that inflation is going to happen over the next few years, there's almost nothing better than to buy real estate. right? Because if everything is going up in price, so is your real estate. So real estate is a really good hedge against inflation. And I think if not that you're probably having inflation conversations with your clients every day, but if somebody mentions that they're worried about the economy, maybe ask that secondary question. And probably most of them are going to say because of inflation. And you should say that's exactly why you should buy a home now. And I should have put it in here. If you want it, message me. But I got some data from the board. I think it's still probably on their website, but they keep track of average prices per year. And if you go back and look at the late 70s and early 80s, you'll see that there was, even though the economy was in a bad spot, real estate prices kept going up through, even when mortgage rates were 18%, real estate prices were still going up, which isn't necessarily the best thing for the overall economy. But if you're worried about not buying a house because the economy is struggle, I think high inflationary times is the exception that you should probably still buy real estate. Um, this chart was also from University of Michigan that does that study every month on consumer confidence. But I thought it was interesting. These are what the average consumer, this is a chart of what the average consumer thinks for inflation and then also unemployment. So you can see that everything shot up around tariff time. And then here in the last couple of months, it kind of dropped significantly in July, and then it's popped up again here. So we'll see. I mean, unemployment's still at 4.2%, so it's definitely still in a good spot, which is basically what most economists would consider full employment. So, all right, now into the real estate world. So this is national. These are national numbers. Our active listing count up 24%, almost 25% year over year. This is less than our local market. But I think some of that is that our local market experienced a longer hot streak, for lack of a better term, than the majority of the country. So already last year, people were already slowing down. So I think we've definitely seen a little bit higher year over year increase due to us kind of slowing down a little bit later than maybe the average market. But you can see that we're still not at pre-pandemic inventory levels, but we are kind of inching we're on the way to those probably next year, or definitely by 2027 if we don't get there next year, which is not bad. I mean, we're still in a relatively balanced market. I think from a listing perspective, I think what a lot of us have felt though is I really do feel, and there's not a ton of data on it, but the number of buyers in the market has definitely been lower. That was the chart. I might have to go off my slide deck. If you guys remind me if we have time, I meant to put those in there and I completely forgot about it. So just remind me, Chris, at the end. I've got some cool charts that I forgot to put in here. Total listing count. I think that every month I'm like, man, I need to go up and look at what the definition. I think the total listing count includes all the in contract properties as well as the active properties, because the number is 400,000 higher. So that was still up 17% year over year. Pendings are down across the nation, which typically is a leading indicator for what's going to happen with home sales. We were making some headway, as you can see. Can you guys see my mouse or no when I do this? Yeah, okay, cool. So you can see throughout the year, actually, we were trending back closer to zero, but then last month it looks like we kind of dropped back down, so overall demand kind of fell off, which flies in the face of my hypothesis about consumer confidence impacting real estate. However, the pendings are probably a lagging indicator, and we certainly haven't seen the impacts of the rate drop in any of this data yet. Median days on market is up another 7 days. So nationally, the average is 58. We are nearing long-term highs on this number. So you can see, I think the only number in the last 10 years, it looks like, or 9 years, that was higher than that was 2017. So that's, again, something to keep in mind. And I think even though we're not as high on the inventory levels, because there are fewer buyers in the market, we're not absorbing as much of that inventory. So the increase year over year is higher than it probably was in 2017 and 2018. However, like we talked about with inflation, the median listing price is still staying pretty sticky. It did stay pretty flat throughout the spring this year, which, as you guys know, is not typical. We usually see more of a spike in that number. But as you can see, it's kind of following that same trend line as we saw. What year was that? 2023, actually. So we're a little bit above last year, and it looks like we're kind of on the same trend line. 2023. This is an interesting one. And to me, this was one of the things that I was like, maybe we're actually kind of bottoming out a little bit, for lack of a better term. You can see that with these types of things where they start at a certain level, I'm always skeptical of paying attention to the actual number too much. But what I do look for are the trends. And you can see that in most years past, we haven't peaked on the percentage of price reduced share until later in the fall. And if this turns out that June was the peak of the total price reductions, that would be a sign that sellers might be getting a little bit more realistic with their price on the front end. I think one of the reasons why there was such a gap in the price reduced share compared to historicals is just because sellers were still living in the market of a year or two ago, depending on where you were at. And so a lot of sellers were still wanting to try to start high and then realizing that they were unrealistic. And so I think that was what we were seeing. And maybe it's only been 1 month, so we can't say there's a trend, but this might be showing that sellers in general are getting a little bit more realistic on the front end. And so they're not needing as many price reductions. Median list price year over year, again, pretty close to zero in terms of an increase when you look at like the regions of the US. Midwest is the winner in this department this time. This is an interesting thing, though, that I didn't put a circle or rectangle around, but something to keep in mind. This is kind of showing our resilience in pricing. So look at versus 2022. So as you guys know, I spend a lot of my time now out in just south of Denver, and the market is way worse there, by the way. So no matter how bad you think it is here, it's way worse there. But it's interesting to see that the West is actually down by 0.1% compared to 2022. So all of the appreciation that the West experienced happened like between 2020 and 2022, and then since then they're flat. So the Midwest again wins in kind of holding a consistent increase in prices. All right, what's happening in Central Ohio? I need to move the picture here. So new listings, July year over year were up 5%, but sales were actually down 0.8%. So as you know, if you're adding a bunch of more new listings and not selling as much as you did last year, you're going to see an increase in inventory. So that number was 36.5% again. I think we've been pretty consistently between 25 and 45, 40 on that number for most of this year. The crazy change, which I think we're all feeling to some degree, maybe some of us to more than others, is what, like, I feel like as a whole, the market was in line with this last year, but the suburbs have really slowed this year compared to last year. So if we jump and look at Dublin, inventory was up 64% compared to last July in Dublin. So, and as we go through these suburbs, you're going to see that kind of prove true through everywhere. But the interesting thing was we peaked in new listings in May. And so I wasn't sure. Sometimes you see a little bump in July. I guess last August did see a bump in Dublin. It still didn't. It wasn't the peak, but it was pretty close. So we'll see I don't know, on this call, we're probably pretty representative of Dublin. How's you guys' listing pipeline? Anybody listing a bunch of houses this month that is going to make that pop, or is everybody slow or the same? What are you guys feeling right now? You guys must not have any Dublin listings coming up, huh?
I don't have any Dublin listings, so
Okay, cool. Well, not cool, but so it'll be interesting to see if that trends, if that bumps up or if we keep going down. If listings, if we kind of peaked in May, that sometimes might say that there'll be fewer on the market and we'll eat up some of this inventory, especially if rates go down. Same thing in Hilliard. So inventory up 61.9, almost 62% compared to last year. And it was only new listings were only up by 8% in July. So it definitely wasn't it definitely wasn't because there were a bunch of new listings.
Hey, Troy,
Yeah,
this is Chris. Just to confirm on this, I think one thing I used to track during COVID is every time we had listings, if we pulled active and contingent, 2/3 would be contingent and 1/3 of the inventory would be active. And what we pulled in a bunch of zips now, that's flipped, which
yeah,
kind of supports what you're showing here. It seems like if we got 7,000 active total, only 22,000, 2,500 will be contingent and 5,000 will be actually still on the market, which is kind of supporting the trend you see here too.
yeah, that's a really good point and a different way to look at it that maybe becomes applicable, but I'm sure you guys are all seeing that too. I mean, when you pull a market analysis on a property and you look at a neighborhood, it's like for the last 5 years, it's been you pull up the neighborhood and it's like you have one active and you have four in contract, right? I mean, I ran some numbers for an investor who didn't even end up listing because of it. But in his area near downtown, um, there was there were 8 active and one pending. And like it was in an area where there's been a lot of turnover over the last few years where investors are buying older houses and fixing them up. And like all the actives were even in good condition and they just were sitting, and there's one in contract. And I'm like, dude, I mean, we can list it, but unless you're desperate, like probably not the best time. And he's like, yeah, I agree, you know.
Yeah.
And
We did the
so
same with somebody that was like, should we rent it or should we sell it? And we gave them that same feedback. So they rented it for another year and see what happens next year.
yeah, absolutely. So yeah, and think about that. If you and I each had the same conversation, how many didn't get listed? The market would be crazy. That's the difference though, I will say, between now and 2008 for all of you. And that graph, well, I'm gonna pull that graph up in a second and we'll go over that because that shows all that. Olentangy, same kind of idea. Inventory up 50% compared to last year. And new listings were up 9%. So the same kind of deal. Now, the interesting thing though is the solds in Olentangy were up 35%, most likely because builders are listing more on the MLS, I would guess, in Olentangy, but still something to keep in mind. So speaking of new construction, July new construction inventory up just 13%. So I mean, it could have been more or less in Olentangy maybe. New listings were up 9% versus the overall market saw a 40% increase. So the resale market had a 40% increase overall, which I think the total increase was like 29. And then new listings were only up 5% and sales in the resale realm were off 1.3%. Sales and new construction isn't super important just because those probably went into contract a long time ago, at least several months ago. So it's not a super good indication of current demand. We already just went over those. Okay. So this is days on market as well as percent of sales price compared to original list price. So pre any price reductions. So the interesting thing is compared to last July, obviously we're up on days on market. However, the percentage of sales price compared to original list price is the same. So again, even though like maybe, I mean, with the higher days on market, it might feel like it, but I think maybe this is an indication that although things are sitting on the market longer, sellers are being more realistic on the front end with regards to prices. Overall supply, 1.8 months of inventory compared to 1.3 last July. So again, about a half a month of extra inventory. And that was, oh, this is just going back. Yeah. So we're looking at still beginning of Q1 in 2019 or the end of 2018 on that. New construction, we're definitely that same half a month compared to last year, but still nothing crazy. With regards to the difference between list price and sales price, this pretty much tells us maybe the sellers are getting a little bit more realistic, but the gap between the active listing price and the average sold price is still pretty similar. Our average sales price in July was still up 3.4%, which is a little bit lower than it has been over the last few months, but still positive, which is good. So 3.4% active prices are down 1.8%. So again, we're starting to see a little bit of pressure on the sold prices, and I would anticipate, like we've been kind of talking about all year, that as we go into the fourth quarter, unless interest rates continue going down, we'll probably see the year-over-year increases come closer to like that 2 or 3%, and it could go as low as 0 or 1. Just based on the amount of inventory that's out there. I think it's going to put a lot of downward pressure on the listings that are still on the market in late October into November, otherwise known as sellers that have to sell versus listing out of convenience. So we could see some downward pressure on like year-over-year prices as we go into the slower season. All right, this is the showing time data that we always put together for you guys. So this is total showings. This is another interesting one. So one of the things that we've started to see in the data as we've had more listings is that I think the average buyer is actually looking at more houses before they go into contract. And so we're actually pushing up. We're pretty well above last year in terms of total showings each week, but we're actually bumping up against 2022 numbers, which is as far back as we can go in showing time. So it'll be interesting to see if that trend continues as we go into the end of the year. But the showings per listing is really where we see the difference. That, you know, we're still staying below. However, I will say as we move into the end of the year, these lines are getting closer and closer together. We look back to early in the year, we had a pretty wide gap on the showings per listing, but as we've moved into the end of the year, that's kind of come back towards the median. So I know this is a lot of work, but we actually pulled this data for a seller who was upset that they weren't selling. And we found that like in the in this specific area, the number of showings had like dropped off by 75% in that last week of July, or I'm sorry, the last week of June, right when they had come on the market. And it kind of showed that like, hey, I know you haven't been in love with the number of showings that you're having, but compared to the market, number one, they're still a lot higher. And number two, the reason why you didn't get what the people 3 weeks before did is because of the time. Like we talked to them back then about getting on the market before that last week in July to try to capture that buyer demand. And I know, you know, this graph shows it a little bit, but I think in most suburban areas, it's a lot more dramatic. that as soon as people don't go into contract by the end of June, people are going on vacation and just the overall number of buyers in the market really tends to dry up. And then lastly here on the local rents, we've been like pretty flat all year. We had a little bit of dip on the average by like 20 bucks, but I would say this is true in general. Most investors, if they've owned it for any period of time or inherited renters, are still well below market on rents. So most properties have quite a bit of opportunity. And I'm anticipating that we get actually some upward pressure on rent prices as we go into next year, as a lot of these multifamily properties that have been under construction since the end of COVID finish up and get rented. And then they're actually predicting that right after we've had this big surplus of apartments, once all of those get filled, then we're actually going to have a deficit because the pipeline of multifamily properties is really dry because of the rate jump. Nothing worked. So people quit starting construction about 2.5 years ago. And so I think we'll definitely see some upward pressure on rates, possibly at the same time that we start to see interest, or not rates, upward pressure on rents, right at the same time that we start to see interest rates drop. So if you have investors that have been on the sidelines or are interested in jumping in, I do think the next year or year and a half could be a really good time, especially with a little bump down in rates right now. Some deals that weren't working might be good. And then last thing I'll say on investors is there's a lot more investor inventory out there now on the multifamily side. So again, if you had anybody out there looking, now is not a bad time because there's definitely some inventory and probably some opportunity for negotiation depending on what people are doing. And maybe we could, Chris, maybe we should do a class on the bonus depreciation, but I think that's another thing. If you want to work with investors and you don't understand bonus depreciation, it's definitely something that you should consider teaching yourself and learning about, and then educating your investor clients on, because it was part of the bill that just passed Congress a month ago. And it's a really big opportunity. And actually, it's the biggest opportunity for everybody on this call because you do real estate at least 700 hours a year. And there's some really unique tax advantages to buying real estate. So if there's ever been a year well, not just a year, it's now part of the law until somebody changes it. So it'll be around forever, but it's back up to 100% this year versus 30 or 40% last year. And so the opportunity to offset your income tax, pretty significant. All right, sources. As you guys know, this is normal trend graphics, mortgage news daily, realtor.com, and then Zillow. I'm gonna go I'm gonna stop sharing for a second since I've got some time. I kind of ran through that. Does anybody have any questions or comments on any of that stuff? I was quick this month. No, nothing, huh?
Oh, Troy, I do have a question.
Okay. Go
So
for it.
I saw this podcast. It was about basically involving BlackRock and how they're affecting certain markets. Would you say their purchasing power with a lot of the inventory just from a national standpoint, is that affecting any type of price ranging or an increase in prices?
So was the gist of the article that they're buying or selling?
More or less, it's that BlackRock is taking a dominant portion or a greater dominant portion of the real estate market compared to a lot of consumers, whether it's first time buyers, doesn't matter. But since they have that dominant portion, I think it's around, I want to say they said 8% of the market, 10% of the market between each state. It's affecting home prices. They had a few good points, but all in all, I was just wondering what your thoughts and opinions are of that.
my overall opinion is that I think that that the BlackRock influence is overblown, especially in Columbus. Now, I think there are a handful of markets where they have a much larger percentage of the market, and in those places, you definitely could see a little bit more influence and pressure on prices. But I think in general, especially in Columbus, like the institutional investors definitely bought here, but not at the level that like Phoenix or Nashville or Austin, some of those markets saw. Um, so overall, I think it's something to consider. I think the way that they would impact the market the most is by deciding that they were going to sell a significant portion of their inventory, which I have heard some of the institutional investors have been selling some of it, which the hypothesis is that they could influence the market. But still, with only 8%, unless they completely liquidate, they probably aren't having that big of an impact. And honestly, from their perspective, it's not going to make sense to flood the market and reduce their own values. So I think it would have to take with them believing very strongly that like the bottom's about to fall out for them to, because like let's say they own 6 houses in a neighborhood, which is how they bought, like they would buy a lot in one area and they would fix up the house, set a new bar with that appraisal, and then they would keep going. But if they flooded a market with 7 new listings and there weren't enough buyers out there, that would cause downward pressure on the prices. And so it would kind of be shooting themselves in the foot. Not to say that they wouldn't be willing to do that if they felt strongly that the market was going to go down, but I don't think that at this point, I haven't seen any headlines anyways that they're believing that there's so much softness that they need to liquidate their portfolios.
Thank you. I
So
appreciate that.
yeah, absolutely. So this was one of the things that I thought was super interesting. So this came from Redfin. And if you message me, I can send you guys, I'll throw this in the slides before I send it out. But if you look at, and I think this would be a great slide to talk to sellers and buyers about, but more so buyers on why now is a really good time to buy. Because you can see, like, if we go back to 2016 and 2017, there was somewhere between 2.2 and 2.5, let's call it, million people in the market buying a house. In June nationally, there was 1.4 million. So that's a delta of like a million. It's like a, what, 40% drop in overall buyer activity. And so what you can also see is that the number of sellers was still under 2 million compared to back then, there was around somewhere between 2.2 and 2.4 million sellers. And so we're still well below like what's considered normal for like the last 15 years in terms of total listing activity. But yet the reason why we're feeling slow is really because the buyers are just crazy low. However, what would happen if interest rates were to drop down by, to 5.75? I think we would see buyer activity shoot up and we could easily gobble up this excess inventory because the inventory is still below the historical average. And so I really think that this fall, especially if we see interest rates go down, is going to be a time where a lot of buyers are going to wish that they would have bought, because unless the long-term trend of interest rates going down is somehow impacted by something that we're not aware of, which is always possible. But I think for the most part, most people feel like a year from now, the rates are going to be a little bit lower than they are now. If you're able to lock in the pricing of today and then refinance later, I think a lot of people are going to be shooting themselves in the foot that they didn't jump on things now, because once rates, if you look at surveys of buyers, once they get a 5 in front of that rate, it changes the conversation pretty significantly. So I thought this was a super interesting chart. Anybody have anything else to add? Questions, comments, concerns, or should I give you guys 17 minutes of your life back?
Well, Troy, This is Tracy Edwards. I kind of lost or missed what the context was of bonus depreciation, why you brought that into the conversation.
Yeah, it was really just around this being a really good time to talk to your investors about opportunities with rents going up and interest rates going down and having a lot of inventory. And then I threw in there that bonus depreciation as a third or fourth reason, however many I'm at there to talk, a third or fourth reason to call your investor clients that maybe have been on the sidelines for a little bit because stuff isn't penciling.
So generically, why is bonus depreciation good? Not a
Basic,
class or anything, but
no, that's okay. Basically, it allows you to write off. So normally with a rental property, depending on whether it's commercial or residential, but if it's like a 1 to 4 family property, you have to write off, you depreciate the asset every 27 and a half years. So every year that you own an investment property, the government makes you take a tax deduction called depreciation, which takes into account the fact that like the windows are 1 year older, the roof is 1 year older. And the government basically assumes that every 27 and a half years, you essentially replace the entire house in one form or another. Bonus depreciation allows you to write off the entire value of the house, not the land, but the house, all in 1 year. And if you spend at least, I think it's 700 hours, Chris, correct me if I'm wrong, but I think it's somewhere around 700 hours in real estate, whether as an investor or as a real estate agent or a property manager or whatever, then you're allowed to actually count that bonus depreciation against your taxable income. So theoretically, you could buy a property that costs 400,000, 300,000 of that property is the value of the building. And you could depreciate that entire building, the whole 300,000 this year, and you could make 300,000 in income as a real estate agent and write all of it off and pay zero taxes.
okay, all right, that makes more sense.
So if you,
So
if
it's my investors could do this, but I could do this too.
yeah, it's really most valuable for all the people on this call, unless your investor is a full-time investor. But if your investor makes enough money off of real estate, it's still valuable because they can always use that depreciation against the real estate gains.
Yeah, and Troy, I don't remember the hour cutoff now. It's always changing, but basically, if you're actively, that's your business. So I think it might be 700 hours, but you couldn't also then have a W-2 job that you were at full time. It has to be your like business, and then you're actively in it. And then instead of being passive, it's active depreciation, like you said. So it's not just depreciating it against the asset, it's depreciating against your income because that's how you make your money.
Yeah, so if you're in the 25% tax bracket on average, which is probably a little low if you're making 300,000, but somewhere around there, that would save you $75,000 in taxes. So that takes an investment that might be like average, right? Like maybe it's cash flowing a couple $100 a month to now what's 75,000 divided by 12? It's a lot of money. So it makes buying an investment property make a heck of a lot more sense than it did 2 months ago, when you could only write off 30% of that asset I think last year it was 30%. So I know that's a little bit in the weeds, but it's definitely something that, again, if you're feeling slow in your business, it's definitely something that I would do a deep dive on and talk to some of your clients, especially investors that are consistent investors, because it's a really big change for somebody who spends most of their time in the real estate world.
Troy.
Yeah, absolutely. Anybody else have any questions, comments, concerns? Or random things? No? All right. Well, I appreciate you guys. As always, email me at troy@marshhomegroup.com and I can send you a copy of the slides. And yeah, I'll see you guys next month.
Thanks, Troy.
Yeah, see you
Or
later.
Thursday.
you.
Thanks, Troy.
Yep. Did somebody ask something?
I said, or on Thursday.
Yeah, I actually will be in person on Thursday for the first time in a long time. So hopefully I'll see you there.
Okay, we'll see you
All
there.
right. Bye, guys.
Thank you.